I'm with Courtiers Chief Investment Officer Gary Reynolds to find out how funds have been performing throughout 2023. Gary, hi. End of 2022, funds are flying, you're outperforming the peer groups. In April, we received 6 awards for performance over 3, 5, 10 years. 2023, we're underperforming against the peers. Can you tell us what's happening?
Well, it's been a massive chase of the larger growth stocks in 2023, Leo. So a huge differentiation in returns from different types of stocks. So if you were going to perform well in 2023 so far, then you needed to have your portfolio stuffed full of growth companies. These are ones trading on very, very high price earnings ratios. So the NASDAQ in the US, which is a good proxy for tech companies, is up well over 30%. MSCI World Value, which is a proxy for your more stable, perhaps profitable, decent cash flow companies, but with fewer growth prospects, up 2 or 3%. So the differentiation so far in 2023 is absolutely enormous, and that's made the difference to returns so far year to date.
Gary, why are the growth stocks outperforming value right now?
I think what's happened is that there's been an assumption in the US that the Fed would cut interest rates and that the economy would hit a soft landing. That, alongside a fixation on AI and artificial intelligence, and people chasing returns of companies they think will benefit from AI, have meant that investors have been prepared to take significantly more risk on the basis that somehow we're going back to a lower interest rate environment. And I think that's a very, very bold assumption, because I'll cover it another time, Leo. But I think fundamentally we've left this bond bull market, i.e. this period of rising bond rates, rising bond values, and on the back of low yields. I think that period's gone. But I think the market has sort of expected the Fed are going to wave a magic wand and bring it back again. And it kind of reminds me like the end of 99, early part of 2000, when everybody thought we were going to the moon with regard to the economy and tech was going to change everything, and everybody chased those tech prices up. And if you remember, it ended in tears.
So as value investors, long-term views, long-term strategies, are you worried at all right now?
No. I guess you want a bit more than that, Leo, don't you? When you've done this for as long as I have, you know you are going to get periods where you are not going to outperform, and it happens very quickly. So, early part of this year, we're collecting 6 Lipper awards, which is a remarkable achievement. That is a massive haul to get 6 awards for results. Then come the summer, now you're having to justify why your results have slipped in the last 4 or 5 months. Now, what I would ask investors to bear in mind is that Courtiers is a value investor because that is the best method of investing for the long term, where what you're mainly concerned with is getting returns on assets for investors that need their capital forever. They need their capital until they die. And what they don't want is us rocking up and telling them that we've just blown their capital up because we've invested in a load of small cap startups or overpriced techie companies and walk straight into a bursting tech bubble as happened in 2000, 2001. So we don't do it. We stick to the companies that have got reasonably good balance sheets, generate cash, and are not trading on too stretched earnings. That's all we do. We do it relentlessly. We don't change, and we don't chase the returns. Now, I always say to teams that process within an investment team is like the leather cords that bound Ulysses to the mast so that he wouldn't jump ship or take his ship onto the rocks when he heard the sirens calling. And that's no different. The sirens calling now are saying, buy big tech, buy at 30, 40 times earnings, AI's coming along, Nvidia, all these other companies, they're going to do really well. Buy the NASDAQ, buy us on these huge multiples. Don't worry about our massive leverage. Don't worry about anything like that, because the Fed are going to cut interest rates and make it okay for us. And we're not going to do it because that's not what we do. That doesn't fit the model. That's not the way you invest long term. And let me tell you, it's not the way that Warren Buffett became the most successful investor the world has ever seen. So we do what we do relentlessly. And someone did ask me recently whether what we've changed. And the answer is we haven't changed anything. And I think when you've got the NASDAQ outperforming to the extent it has this year, if we were up there with it, then I think investors should be sacking us, because that's, they don't pay us to do that. They don't pay us to chase the short-term returns. So here we are, 6 awards for performance over 3, 5, 10 years. Still fantastic 3, 5, 10-year returns, but not such a great 6 months. And it all comes down to the fact that the type of stocks that we refuse to hold have performed very well recently.
If this is happening at the moment, when do you expect that we might come out the other side of it and markets might begin to favour value again?
Well, markets have favoured value in the long term, and there's a fundamental reason for it. And it's around the same reason that people buy lottery tickets. Lottery ticket is about the worst investment you can make in the UK, because the payout after you take account of costs and what the government gets and the payment to good causes is only around about 50%. Can't remember the exact figure, but it's around 50% there. So why would you buy a lottery ticket? Why would you buy a lottery ticket when long term you're certain to lose 50%? And the answer is because every now and then somebody wins big. And as human beings, we have a desire to really think, what would it be like if we won really big? And that draws people to buy lottery tickets, and it draws people to buy the companies that they think will be the next Apple, the next Amazon, the next Microsoft. You chase those returns, ignoring the fact that for every one Microsoft, there are thousands of failed businesses, thousands of them. And you're more likely to pick up the wrong types of businesses and lose everything than you are to find another Bill Gates that's going to make you money relentlessly for decade upon decade. So what you do is that you look for the businesses that are generating cash, that they're not popular. And because of this, because of the market is always having a quest to find the big winners, it overprices the growth companies and it underprices what we call the value companies. And so if you relentlessly, in a disciplined fashion, keep focusing on value in the long run, you produce the returns that your clients and investors need to achieve their objectives, and you do it with a lot less volatility than if you're chasing the racy stocks. So we are unapologetically boring with our approach, and we relentlessly do it. And if anybody's wondering, has anything changed at Courtiers, I'll tell you, no, nothing has changed. And that is why 2023 to date has not been the best year for us. A few years back, I had a good chat with a guy called Jeremy Lang, ran Lion Trust Equity Income. And we were discussing, why doesn't value investing get arbitraged away? In other words, if everybody knows in the long run it's the better way of running money, why does it continue to be the better way of running money? Because if everybody jumped on the bandwagon to invest in value, then there'd be no advantage for value over growth. And he said something which I never forgot. He said, every generation forgets. And you think, yes, of course they do. The next generation comes along. They think they're gonna, think the old generation, my generation, are the sort of guys that are going around in black and white film when they were in their 20s. In fact, no film at all, because you didn't have anything to film anything on your cameras. You know, you played outside rather than playing on computers. If you got some catering at a football match or a rugby match, it was a a pie with one little bit of meat in, a cup of bovril. Everything was so different then. And the next generation thinks their generation have found all the new ways, and so it is. But it never, ever is the case. Things evolve much more slowly than people think. And it certainly is the case in investment management. One of the reasons I love investment management is because it doesn't change too much. If you're going to be an expert in IT or an expert in law or an expert in pensions legislation, you're constantly battling to keep up to date with what's going on. Well, actually, what you're constantly battling to do is, as an investment manager, is just make sure you don't get sucked into believing that it's all going to be different tomorrow. How many times have you heard that? This time it's different. They all believed it in 99, 2000. We all believed it in 2006. Well, we did. The market believed it in 2006-07. We're going to the moon, and it doesn't happen. And I've seen it so many times. Good news is when you get these radical swings, you've got a very good chance with mean reversion of getting a radical swing back the other way. Now, let me say straight off, I'm not promising to turn the whole tide round like we did a couple of years ago and go from behind in June to stuffing everybody by the end of December. But my guess is, Leo, that when I'm on my feet in December, and anybody watching this can clock it and ask me the question then, is that the situation will look significantly better for us than it does today.
If somebody said to you, I've got a lump of money I'd like to invest, should I do it now or should I wait a while? What would you say to them?
Well, if you're going to invest, why wait? Why wait? If that's money that you're going to need in the next 2 or 3 years, then please don't give it to us. Stick it in a bank or building society. You're going to get a much better interest rate than you got a couple of years ago. So that's good. But if it's long-term investment, then this is a good time to be in. But if you're looking and thinking you're going to come in because you're looking at the performance of NASDAQ stocks this year and you want to get a piece of that for the next 6 months, good luck. Please don't come and give that money to me, because I'm not going to buy the type of stocks that you think that are going to win. And I'm not going to buy the type of stocks that have won big in the past 6 months. I'm going to stick with the ones that we've been buying for all our lives, that are the ones that that you feel comfortable with, that we've got the earnings. And if you're that way minded, then this is a great time to invest. But as you know, Leo, compliance are going to say that comes with all the normal warnings that markets go down as well as up, and you don't necessarily get back your value of capital that you put in markets. But look, you're buying, if you're looking at those stocks in our portfolios at the moment, you're buying them at very, very low metrics, and it looks pretty good to me at the moment. Then bringing it nearer to home, all my money is in our funds. I don't hold anything else. That means I'm never worried about, when I get up in the morning, do I worry about the stuff I hold personally or Courtiers funds? I worry about Courtiers funds. And all my money's in that. It's called the old-fashioned skin in the game. And I think that's the only way you should ever run money. I think as an investment manager, you should never hold it elsewhere. And let me tell you that all my long-term assets are in our funds. I'm not trying to be clever with cash. Cash is there for stuff that I might need in the next couple of years, that's all.
Thanks, Gary. Last question. So, as value investors, rather than investing in the big growth stocks and the tech stocks, Courtiers aims to maximise returns but also minimise risk. Is it fair then to say that maintaining this value approach through a time where there's significant interest and returns through the tech stocks, that we're working to effectively minimise the risk at the moment?
Absolutely. Absolutely, Leo. That's key for us. That's why we do so much work looking at the value of the business for the future returns, looking at what it does, looking at its leverage, looking at its balance sheet, making sure it produces cash. That's a key metric for the past 20 years, because the one thing that would have told you what was and wasn't a good investment in 99, 2000, just before the tech bubble burst, was the company generating any cash? Enron was making profit, but it wasn't generating cash. the reason that all its profit was paper. It was just fiddling its books. So companies that generate cash, which ultimately is what you want. In the end, a business has got to give back its shareholders cash so that they can get a regular income stream to buy things, live on. A company can't go on being a growth company forever. In the end, it's got to deliver, and I think that's you look at our businesses, they're cash generative, they're not over leveraged, they're good businesses, good solid businesses. It's an exciting time to be in the market, I think, Neil.
Gary, thank you for your time. We'll get this out and look forward to catching up with you again soon.